Hello everybody, this is AK. I'm back. So today is Mother's Day. So to all the mothers, happy Mother's Day. And today's video is going to be about DBS, right? Amongst the three banks, DBS, OCBC and UOB, I think there is the most how should I say this, debate about DBS. DBS has the most debate when it comes to whether it's a good investment or whether it is overvalued, that kind of stuff, right? There's a lot of disagreement and I wouldn't say fighting, but definitely sometimes it gets a bit aggressive and confrontational, right? And there are so many people who say, and there are some financial influencers who say, "Oh no, DBS is too expensive, right? It's overvalued. Don't buy DBS shares," and there are people who say that no, it's not overvalued. It's fine, and which camp do I belong to, right? I don't think I belong to either one of them. I'm neutral Switzerland. Well, for those people who say that DBS shares are overvalued, I can see where they're coming from. They are probably just looking at price to book, right? If you look at the price to book of DBS shares, I mean, they're trading at 1.8 times price to book. Now that the price has come down, at one time it was trading at 1.9 times price to book and even quite close to 2 times price to book. So, and by that metric alone, it looks expensive, right? Very expensive, right? And so, and I made a video some time ago about how I changed my mind about DBS, and that 2 times price to book might not be that unreasonable after all, because DBS, unlike OCBC and UOB, and what sets DBS apart from OCBC and UOB is its very impressive ROE. And this is something that we can argue about, we can debate about whether they're able to maintain that impressive ROE in 2025 and beyond, right? And then of course there are some people say, they're changing CEO, Chief Executive Officer. For a moment I got mixed up with COE. Okay, so and first quarter 2025 results came in, and ROE 17.3%, still very impressive, right? And their ROE has been hovering about 17 to 18%. At one time was like close to 19%, and that's really impressive. If you compare that to OCBC and UOB, they're under 14%, it's like 13%, something around there. So that alone, I say, justifies DBS share price, trading at a bigger premium to book, right? So book value is only one of the many measures that we can use, and if we just look at book value, we might miss the more important details, right? And similarly, compared to UOB, right? Where we're comparing with UOB, I mean, their net interest income has also come in higher, about 1% higher. And so I think the concern about interest rates coming down and might be overblown, right? Like in the case I made for UOB in yesterday's video, interest rates might stay higher for longer, even in 2025. And even if interest rates come down, we could see loan growth, right? And that could still lead to higher net interest income, especially if we believe that a recession in US might not happen, or if it is going to be quite mild, right? And in terms of cost to income, DBS has always been very good with this. Cost to income ratio is 37%, so they're able to keep their costs pretty low, very efficient when it comes to that. And their CET1 ratio is 17.4%. A lot of excess capital, very strong balance sheet. They're not going to go kaput anytime soon, right? And that's why they are returning so much money to shareholders by way of special dividends and also share buybacks, right? So now, as an investor for income, I know I'm going to get back like $3 per share this year, and that's pretty amazing. You're looking at about like 7% dividend yield. But if you have to remove that 60 cents special dividend, then it's like $2.40 per share. Even the normalized dividend yield, you're looking at something like 5.5, 5.6%. So that's pretty good as well. Right, and all this on the back of a payout ratio, of 50 to 60%. It's pretty good, right? And that's the reason why I say, why do I bother investing in the so-called blue chip REITs, real estate investment trusts, when I can get this kind of returns from investing in our banks, right? And the REITs have to pay out 90 to 100% of their income in order to give you 5-point-something%, 6% yield, right? And their balance sheets are nowhere as strong as the bank's balance sheets, right? So, I mean, DBS at the current price, about $43 per share. It's about 1.8 times book value, and P ratio is about 11 times. P ratio is about 11 times. But like I said, it's trading at a richer valuation than UOB because of its very impressive ROE, return on equity. And I think it's a fairly good investment. It's not overvalued even now. But would I buy more? Well, if the share price should pull back, right, 15%, or if Mr. Market goes into a huge depression like 20%, yeah, I think I might actually be tempted to buy more, right? So, like I said, I'm not worried about staying invested in DBS, OCBC, and UOB. Very good investments for income, and they are also growing, right? They retain a big chunk of their earnings for growth. They don't have to come back to shareholders to ask for more money. They don't have to raise capital, right, to do so, unlike the REITs. So this weekend we look at UOB and DBS, and I hope it has provided some food for thought for those people who are still skeptical about investing in the banks. And I hope it has provided some comfort for people who are worried about their investments in the banks, right? But for sure, all of us should have our own plan, and don't just listen to financial influencers, including myself, and think that everything will work out the way financial influencers say they should, or they would, or they could. Right? So if AK can talk to himself, so can you. Bye-bye.